The end of the free era. The news is official. The Bank of Japan has raised interest rates to 0.75%, reaching the highest level in over 30 years. In the last video, I warned you that December 19th would be the turning point. They might raise the rates. They're about to cut up that credit toy. A liquidity shock. You're looking at the wrong chart, and that's exactly what I'm. The Bank of Japan just made its announcement, and the markets are reacting right now behind me. Okay, the news is out. Is the danger over? Can we relax for Christmas? The answer is a firm no. In fact, what happened just a few hours ago in Tokyo isn't the end of the story. It's just the click of the trigger. The real explosion, the mathematical consequence of what we've just seen on the charts, has a different date. A date that almost no one is paying attention to because everyone is distracted by today's price. Friday, January 9th, 2026. So make yourself comfortable. Today, we won't just be analyzing this morning's old news. Today, we'll connect the dots between the BOJ's decision, the Fed's phantom QE that no one is telling you about, and a massive statistical bug that will turn January's data into a minefield. Let's start right away with the fresh quartz. What happened last night in Japan, and why is it the linchpin for January? The Bank of Japan had to decide whether to shut off the tap of global liquidity or leave it open a little longer. It was a unanimous decision. With inflation biting at 3% and wages rising, they had no choice left. The market reacted violently. Yields on Japanese government bonds broke through the 2% barrier, something we haven't seen since 1999. This puts immediate pressure on the carry trade. It means that big funds have to start selling American assets to bring the money back home. Bitcoin isn't reacting much at the moment, but we'll see how it behaves when the American markets open. Global liquidity was reset today, but while everyone is watching Tokyo, something much sneakier is happening in the United States. Do you remember those messy, heavily revised jobs numbers we talked about in the last video? Well, starting in 2026, those numbers will undergo an even worse mathematical shock. That's why January 9th is the date to watch out for. Before I reveal this mathematical bug that no one is factoring in, let's make a deal. This seemingly quiet holiday period is statistically the time when fatal mistakes are made. People let their guard down and the market strikes. I'm not taking a vacation. If you don't want to wake up on January 10th with your portfolio on fire because you missed a crucial piece of news while you were having lunch with your relatives, subscribe to the channel right now. Turn on the notification bell. My job is to filter out the noise and bring you only the signal. Done? Good. Now let's look at the data. Alright, now we're getting to the heart of the nightmare. Why did I call January 9th the Day of Judgment? Because that Friday, the first non-farm payrolls of 2026 will be released. And while the S&P 500 is celebrating at all-time highs, there's a silent cancer eating away at the real U.S. economy. Unemployment. The seasonal Christmas hires will end on December 31st, and on January 9th, the king will be naked. But there's a deadly technical detail that nobody is telling you. Starting in 2026, the math changes. The government algorithm that cleans and seasonally adjusts these data is based on the average of the last 5 years. Guess which year gets dropped from the average calculation as soon as we enter 2026? The year 2020. By removing that shock year from the historical average, the January data won't just be volatile, they'll be a total statistical shot in the dark. The compass will break on that very Friday. Here are the two chilling scenarios. Overheating, if the data comes out too strong because of the algorithm, inflation bites back, the Fed can't cut rates, and the market goes into withdrawal. Or the collapse of reality. If unemployment shoots up, the soft landing narrative dies. Hello, recession! The market is pricing in perfection, but with a statistical change in 2026, on January 9th, we might find out that perfection doesn't exist. However, the market can be ruthless. While the real economy risks a heart attack over the data, there will be a show to distract you. Right in the week of January 9th, CES 2026 will take place in Las Vegas. While the macro data gets worse, technology will make another quantum leap. Humanoid robotics, new hardware chips, and pay attention, right around those days, there's talk of the confirmation of SpaceX's APO, a media event that alone could drain billions in retail liquidity. But listen closely, because this isn't just hype. The data from investment banks tells us something frightening. Today, 2/3 of the real growth in the US GDP depends exclusively on investments in AI. You heard that right. If you take away artificial intelligence, the US economy is basically at a standstill. It's the only light on in a dark house. This will create a monstrous divergence. We could see the old economy collapse on the January 9th data, while tech gets pumped up by news from Las Vegas and from space. Don't be fooled. If the market crashes on January 9th, it will drag tech down with it in the short term too. But that will be the moment when smart investors will make the shopping spree of a lifetime. And this is where the asset that could define 2026 comes into play. While stocks and bonds argue over recession or inflation, Bitcoin is playing in a league of its own. The thesis is no longer speculation. The thesis is the sovereign debt spiral. The US has to print dollars. In fact, it's already happening. No one is telling you this, but the Fed has already activated a stealth QE, officially called reserve management. They are quietly buying $40 billion worth of T-bills every month. Liquidity is already coming in through the back door. But look at the on-chain data. There's a crazy anomaly. The deafening silence. Retail investors are absent. On Google, crypto is at its lowest point. The little guys are out. The supply shock, the smoking gun. Whales are draining the supply. And this is a fact that will blow your mind. Just yesterday, while the market was crashing, sentiment was in the gutter, and you were panicking and selling, Wall Street did the exact opposite. In a single day, Fidelity and the other spot ETFs loaded up almost $500 million, $457 million to be exact. Did you get that? The price was dropping, but they were buying hand over fist. This is the biggest divergence between price and institutional inflows we've seen lately. They know something you don't, and for those who fear a total crash, there are two magic numbers you should burn into your mind, the so-called kill zone. The first is $74,000. This is the key level estimated as the pain point, or a recent break-even price for a MicroStrategy. The second is $70,000, which is the current average cost for miners to extract one Bitcoin. It's a reinforced concrete wall defended by the biggest financial players on the planet. If on January 9th the data is terrible and the Fed prints even more, Bitcoin goes up. The volatility on January 9th could be the last shakeup to throw you off before the real climb begins. Don't look at the price today. Look at who's buying $500 million while you're scared. So to sum up the roadmap so you don't blow up during the holidays, BOJ, the game is set. Today's reaction is just the appetizer. January 9th is D-Day. The 2020 statistical glitch will make the data unpredictable. Distractions. AI is keeping the US GDP afloat, and SpaceX IPO will distract the masses. But you keep your eyes on the macro data. Bitcoin, Wall Street is buying the dips, 500 million in a single day. Watch the 70 to 74K zone like it's your Maginot Line. My strategy? Extreme caution now, so I can be aggressive later. Remember the last video about 1998? That scenario is still valid, but to ride the wave of 1998, we have to survive the shock at the start of 2026. So I'm building up cash liquidity now, not to run away, but to load the gun. I'm waiting for January 9th like a sniper, ready to buy at prices others can only dream of. Don't chase the green Christmas candles without volume. They're tourist traps. As promised, I won't leave you alone in this minefield. I'll be here on January 9th to comment on the data in real time. But there's more. From now until then, if any important data comes out, I'll make a quick video to let you know. So subscribe now. Don't give your money away to the market out of carelessness. See you in the next video. Stay ready. And if you want to understand exactly how we predicted today's move and what hidden signals most analysts ignored, click now on the video you see here on the screen. That's where you'll find the logic that brought us this far. See you over there. The contents of this video are purely for informational and entertainment purposes. They do not constitute financial advice. The opinions expressed are personal. Every investment involves risks. Always do your own research before investing.